tentative rally?
A little bit tentative. I'd say, it's respectable. You want the market to bounce after a day like Friday. I don't think it necessarily was decisive one way or the other in terms of whether this was truly a lot of people finding value in here, feeling as if we were just stretched a little bit to the downside. Remember that close on Friday was very much, we don't know the details of what's coming next from the president. There was a suspense in there.
And then it came.
And then it came, and then we had 2 or 3 days of kind of switchbacks on that news. So to me, one of the things the market is benefiting from in a broad sense is that people were not over-enthusiastic and greedy and really aggressively positioned in this market before this little bout of trade static. So I think that that's okay. People were already a little bit cautious because of the Fed picture and all the rest. So that basically means, it doesn't mean the clouds are going to part, but it does mean that people are not shocked by the fact that things don't look perfect in the outlook.
Kari, what do you do with this market?
Well, I think it's important to look at where we are technically, as Mike talked a little earlier. We have bounced back and forth across 2,900 on the S&P 10 times since April. And that, to me, says that investors go from being bullish that we've got a trade deal to bearish that we don't. And I think it's more about trade than anything. So what you have to do is find a place, if you're comfortable with the market, to stay invested in the kind of companies that can weather this storm. But until we get a deal, I can't imagine that we can stay above 3,000 on the S&P and reach new highs and stay with the new highs.
So, Mike, there's a big article in the Financial Times today saying the world's top wealth manager urges clients to sell stocks about your firm, UBS. So what are you guys saying now to clients?
Well, so first, let me give you a little context around that. We're not telling people just go out arbitrarily sell stocks. What we are doing is we've told people to trim some risk positions. We actually have taken our overall global equity weight down to a modest underweight from a modest overweight. And it's really based on a couple of things. One, Terry just talked about. I think the uncertainty of trade is starting to have a bigger impact, not just in terms of market volatility, but what it means in terms of business confidence. Remember, the economic impact of the trade tariffs and the conflict, the first order effects were never that significant. But the longer we go, the more it begins to undermine business investment confidence, the more it has potential consequences down the road. So from a positioning standpoint, we want to be a little careful around that. I also agree with what Terry said before as well. We want to be a little bit more positioned defensively in terms of stock ownership. That's why we're going to be in the less cyclically sensitive sectors. And in terms of our regional preferences, the area where we're neutral on is actually U.S. equities. Our underweights are actually in the emerging markets and the non-U.S. developed.
It's hard, though, Mike, to be so tactical, no? For the very reasons that we've discussed since we began the program at straight up 3 o'clock. Because of the twists and turns, the tweets and headlines, the changes in positions or comments or stories. How do you be a short-term tactical person in this marketplace?
I think it's really hard to do, and I think you put it well, this notion that we can simply trade around all this news. There's a sense that we're only a tweet away from triumph or tragedy, and I think that's sort of the way the market's reacting. So I think we have to do is we have to put that aside for a moment. Don't try and out-trade the headlines. What you want to do is remain committed to an investment strategy where you've got positioning in market that you think is appropriate given where we are in the growth cycle, where we are with regard to what the Fed's likely to do over the course of the next 6 months. And don't try and overguess what either the Fed is going to do or what the president's going to do in his next tweet.